Hello student, I Dr. Shafali Jain, Assistant Professor, Tirthankar Mahavir University. Student, today we discuss about Block 4 investment. Investment refers to putting money, resources or time into venture with the expectation of generating future financial returns. It involves the purchase of financial assets like bonds and stocks or investing in real assets like commodities or property with the expectation of earning a profit. So, so in the simple words, an investment is the purchase of goods that are not consumed today, used in the future to generate wealth. In other words, we can say investment is the value of fixed capital assets produced in an economy over a period of time. Investment refers to the creation of capital goods, investment expanding in and injections to the circular flow of income. There are three main types of investment as you see in the screen, which are follows: business fixed investment, residential investment, and investment. First of all, business fixed investment. Business fixed investment means investment in the machines, tools, and equipments that businessmen buy for use in for the production of goods and services. The stock of these machines or plants, equipment, etc. represent fixed capital. The terms fixed in it implies that expenditure made on the machines, equipment, etc. continues to be used for production for a relatively long time. Business fixed investment is the important in two respect. First, business fixed investment is an important component of aggregate demand and therefore plays a significant role in the determination of natural income and employment. Secondly, business fixed investment is a volatile component of aggregate demand, which means that fluctuation in levels of fixed business investment is responsible for business cycle in a free market economy. So, according to Keynes, business fixed investment determined by expected rate of profit, which he calls marginal efficiency of capital, and rate of interest. Since rate of interest in the short run is relatively sticky, it is changes in expectation about earning profits in future that cause fluctuation in business fixed investment. And it is according to new classical theory, business fixed investment is also determined by marginal product of capital and user cost of capital. The user cost of capital merely depends on the price of capital goods, interest rate, and the depreciation rate. Second is residential investment. Residential investment refers to the expenditure which people make on constructing or buying new houses and dwelling apartments for the purpose of living or renting out to others. Two important features of residential investments. First, since the average life of a housing unit is of 40 to 50 years, stocks of existing housing units at a point of time is very large as compared to the new residential investment in a year. Second, there is a well-developed resale market for housing units so that people who construct or own them can sell them in this secondary market. Institutional investment depends on many factors. Firstly, residential investment depends on price of existing housing units. The higher the price of existing units, higher will be investment constructing and buying new houses units. Secondly, in the long run, demand for housing is determined by rate of population growth and formations of new household. The higher rate of population growth leads to the increase in demand for housing units. And thirdly, demand for residential investment. Income is determined by the level of income. Since level of income over time fluctuates a good deal, there is a strong cyclical pattern of investment in residential constructions. Fourth, interest is another important factor that determines demand for dwelling units. Most houses, especially in cities, are purchased by borrowing funds from banks for a long time, say 20 to 25. Now we discuss about inventory investment. Inventory investment, the difference between good produced, any production, and goods sold, sales in a given period is called inventory investment. In other words, inventory investment is a change in the stock of materials, work in process, and finished goods within a firm's industry or entire economy over a specified period of time. Firms hold inventories of raw materials, semi-finished goods to be proceeds into final goods. The firms also hold inventories of finished goods to be sold shortly. Change in the inventories or stocks of these goods with the firms is called inventory investment. Inventory investment of raw material when goods is determined by on the level of the output which a firm's plans to produce, an important model that explains the inventories of raw materials and goods in the accelerator mode. According to the accelerator model, the firms hold the total stock of inventories of raw materials and goods that is proportional to their level of output. So we can see an investment involves using capital in the present to increase the assets value over time. Investment may include bonds, stock, real asset, or alternative investment. Investment can be diversified to reduce risk through this may reduce the amount of earning potential. So, investment is also broadly categorized into autonomous investment and induced investment. And induced investment Induced investment refers to the investment that is stimulated by fluctuation in income level of economic activity of a country. Induced investment directly related to the level of income, meaning that when the income of a country increases, induced investment increases and vice versa. Moreover, induced investment is based on the profit motives, which means that investors will increase investment in ventures where the profit probability of profit is high. Means, in simple, induced investment refers to that investment changes as the level of income changes in the economy. Therefore, it is the type of investment that depends on the level of income in the economy. So, the investment which depends on the profit expectation and has a direct influence of income level, or it is known as induced investment. Induced investment is income elastic. It means that the induced investment increases when income increases and vice versa. So, induced investment involves expansion in market and increase people income, boost their purchasing power, leading to rise and in aggregate demand. The increase in aggregate demand AD leads to an increase in investment and business opportunities, resulting in market expansion. Increase in economic activity reduce investment promotes the production of goods and services, leading to an increase in economic activity. Employment opportunities induce investment in different ventures leads to new jobs and employment opportunities, resulting in an increase in household income. Economic growth and development. Induced investment has sustained economic growth and development by expanding business and industries. Now, we can also understand the induced investment with the help of the curve. Induced investment is directly influenced by the change in the income level, which has a positively sloped curve. When income is Y0, figure show as income rises from Y0 to Y1, Y0 to Y1. Investment also rises from M0 to M1. The induced investment curve depict the positive relationship between the level of income and investment. So, when income, so it is also represent relationship the level of income and investment. So, induced investment is response to changing output. This applies at a macro rather than a micro level. Investment by a firm cannot be technical response to its past output, which has already been produced with the capital in place. Investment may, however, be affected by output changes through their effects on profit. When output rises, because overhead costs can be spread more widely, profit rise, and this both provides funds for investment directly and makes it easier to borrow. Investment, induced investment is not determined by future changes in a firm's output. Output and investment plans are formed. Investment by each firm respond to expectation about market prospects. So, We can say induced investment refers to the investment made by businesses that vary with the changes in the level of income or economic activities, rises when income increases and falls when income decreases. Uh, and income decreases and increases and fall when income decreases. This types of industry is directly influenced by the economic environment and consumer demands, thereby making it income dependent. In contrast, we will also discuss about the autonomous investment. Autonomous investment does not depend on income changes. It stays the same regardless of whether income goes up or down. It is important for investors to understand the difference between autonomous and induced investment to make decisions related to risk and expecting returns during different economic conditions. So, induced investment refers to the investment businesses make based on their profit expectation. Usually, these expectations are influenced by correct income level. For example, say the income level of people rises. Now they spend more on goods and services. Anticipating higher demand, businesses will invest more in expanding their operations. They will buy new machineries or open more stores and stock to satisfy this increasing demand. On the other hand, if income falls, businesses will reduce their investment. As we can observe that increased investment increases with rising income and decreases with falling income. Now we discuss autonomous investment. Autonomous investment is a type of investment that is not affected by change in a country's income or economic activities. Instead, it is driven by factors like government initiatives, technological advancement, and research. Government, businesses, and individuals undertake this investment without the primary motivations of generating a profit. Such investment involve exploring new business opportunities, developing infrastructure, promoting innovations and technology, etc. However, autonomous investment is income elastic because it remains unchanged regardless of an increase or decrease in the income of country. Autonomous investment is often regarded as a crucial factor in driving economic growth and development. It results in the creation of infrastructure such as road, hospitals, bridge and dams by the government. Moreover, it leads to the development of new product innovations and better services, which is which in terms fosters economic growth and development. So, autonomous investment is influenced by the following factors. First of all, government policies. Different governments initiatives for the welfare of the public, like infrastructure development, subsidies, and tax incentives, encourage autonomous investment, technological development, and innovations. Businesses invest in new technologies to enhance efficiency in the production of goods and services. With it, new investment and business opportunities investing in the untapped resources and emerging markets result in the economic growth and development and research and development. By investing in research and in development projects, Businesses gain valuable insights into market competition, consumer behavior, new products, and innovation. So, autonomous investments also very helpful with all these activities. So, an autonomous investment is the type of investment that does not depend on current income or economic condition. It remains fixed or static regardless of the country economic situation. Generally, an autonomous investment represents the essential investment made by the government private sector, such as spending on infrastructure, healthcare, and education. These investments are made to achieve long-term goals and social benefits. So, as you discussed with us, an autonomous investment is when a government or other body makes an investment in a foreign country without regard to its level of economic growth or the prospects for that investment to generate positive returns. These investments are made primarily for purposes of geopolitical stability, economic rates, improving infrastructure, national or individual security, or humanities goals. So, autonomous investment is the portion of the total investment made by a government or other institutions independent of economic considerations. These can include government investment funds allocated to goods or infrastructure and any other types of investment that is not dependent on changes in GDP. In contrast to induced investment, which seeks to take advantage of economic opportunities. Autonomous investment is made for necessities or purposes of the stability or security. Autonomous investments are made because they are deemed as basis necessities to individual, organizational, or national well-being, health, and safety, and are executed even when the level of disposable income for investment has or grows. So, autonomous investment include inventory, government investment in infrastructure projects such as road, highways, and other investment that maintains and enhance country's economic potentials. They do not increase in response to higher GDP growth or shrink in response to economic conditions, indicating that they are not motivated by profit but rather by the goal of improving societal welfare. So, here you see autonomous investment is an horizontal straight line that is independent of changes in economic activity and income level of a country. You see, the figure shows that investment remain same at MO level despite the increase the level of income. So now we discuss the differences between induced and autonomous investment. First of all, induced investment. It is influenced by the changes in national income or economic activities of a country. As I discussed with you, autonomous investment, it remains independent of the changes in the national income or economic activity of country, as you see in the figure also. Okay? Motives, profit motives, and autonomous investment, like public services, efficient product, information, nature. In this investment, income elastic, and autonomous investment, income inelastic. Determinants, induced investment determinates national income, aggregate demand, and interest rate, while autonomous investment government policies, technologies and innovations, research and development, and new business ventures. With it, characteristics induced investment, it is a volatile and often fluctuate due to the changes in business cycle. While autonomous investment, it is less volatile and stable. With it, induced investment, the impact of the induced investment would result in short-term growth, employment opportunities, and market expansion. With it, autonomous investment, it result in innovations, productivity, better public services, and long-term economic growth. With it, induced investment, the example of induced investment, increase in production of uh, goods and services due to increase in consumer demand, while autonomous investment in research and development by a company to make efficient product. So I discuss autonomous investment stand in contrast to induced investment, which increase or decrease in response of economic growth level. Induced investment aims to generate a profit. Since they respond to shift in output, they tend to be more variable than autonomous investment. So, for example, as disposable income rises, so does the rate of induced consumptions. This process applies to all normal goods and services. Here have more disposable income in a better position to save or invest money to be used as future income. So, autonomous and induced investment can be thought of in terms of marginal propensity to invest. The change in the invest expressed as a proportion of the change in the economic growth. When that marginal propensity is zero, the investment is autonomous. When it is positive, the investment is induced. So technically, autonomous investment are not affected by external factors. In reality, however, several factors can affect them. For example, interest rate have a significant impact on investment made in an economy. High interest rate can tamp down on consumption, while low interest rate can spur it. In turn, this affects spending within an economy. Trade policies between countries also affect economic investment made by their citizens. If a producer of cheap goods imposes duties on export, then it would have the effect of making finished product for outside geographies more expensive. Government can impose control on an individual autonomous investment through taxes too. If a basis household goods is taxed and no substitutes are available, then the autonomous investment partly it may decrease. So, as you see, induced investment that depends upon the profit expectation and has a direct influence income level. While autonomous investment, the investment on which the change in income level does not have any effect and is induced only by the profit. And the motive behind the induced investment is profit. It means that is depend on profit expectation. While autonomous investment, the motive behind autonomous investment is social welfare. And induced investment is income elastic. It means that induced investment increases when income increases. And vice versa. While autonomous investment is income elastic. It means that it's a change in income, increase or decrease. The autonomous investment will remain the same. And induced investment is income elastic. It's curves slow upward. As you see in the diagram, an autonomous investment is income inelastic. It causes parallel to accesses, as you see and discuss in the diagram. In general, induced investment is done by the private sector, while in general, autonomous investment is done by the government sector. And induced investment is positively related to the national income, and autonomous investment is unrelated to the national income. So, student, I think you well understood what is induced investment and what is autonomous investment. So, in conclusion, autonomous investment are and induced investment are two main types of investment in the economies. Induced investment is influenced by changes in economic activity and income, whereas autonomous investment is driven by government policies, research, and innovation. Understanding the key differences between these two types of investment and investment has government business and individuals make informed decisions about resources allocation and investment strategies. Well understood what is the induced, what is the investment, what is the induced investment, and what is the autonomous investment. Now, thank you very much.